Okay, so now we are going to make the actual T accounts. Okay, so this is how a T account looks like. This side is your debit. This side is your credit. We have, you know, we write the rate, date, the year, okay, for writing the entries. And then we write the date. Let's say, we are doing entries in July. So I'm going to write July here. And whatever my entry is going to be, I'm just going to put the date in front of that. Let's say, I'm going to do my first entry on 1st of July. So I'm going to write 1. The second entry I'm going to do on 4th of July. So I'm going to write 4 here. Okay. So we debit here. Let's say first entry is debit 500. Second entry is debit 600. Third entry happened on 8th of July, and that is credit 700. And let's say that's our expense account. Okay, that's our asset account. An asset of van. So we bought the asset. It means we paid in cash. Okay, so we credit cash and we debit van. So I'm going to write here the opposite account, which is cash. Okay, let's say we bought another van and that we bought on credit from J Perks. Okay, so I'm going to write the opposite account here, which is J Perks. I debit the van and I credit J Perks. This is what it's showing. And then we sold off the van on 8th of July. So we sold off and we are going to make the opposite account here. We're going to write the opposite account here, and that is disposal. You don't need to be worried about it. We have a separate topic related to disposal. So the point is that this is how we make the T accounts. That's the format of the T account. Okay. At the end, we add both sides and see which side is bigger. So when we add this side, the total is 1100 and this side is only 700. Okay, so we are going to write the bigger side on both sides, 1100. And the difference we are going to write here. Okay? The difference is 400 and we call it carried down balance. The carried down balance is like at the end of the day, that's the balance we have for van. Okay? And that becomes brought down balance for the next period. Okay? So, you're making the account for next year, for example. That's going to be the brought down balance, and that would be coming here. Okay? So, so that's how we make the accounts. Okay? That's the format of the T accounts. Let's try an example. Okay, so we are going to make these T accounts in an Excel sheet, so that would be easier to handle. So enter, that's our question, enter the following, in the appropriate creditor's accounts, which is supplier's account. So, okay, so, we are just going to make these accounts, just forget about the requirements. So we have purchases on credit from J240, P Todd, and J Fry. Okay. So we're going to make, because that's a purchase, so we're going to make a purchase account. A purchases account is going to be debit, okay, with these amounts. So we're going to write the date here first. That is 2008, June. And on 1st of June, we're having these entries. So we did the purchases of 240, 390, and 810. Okay. And we did the purchases from these accounts, J7, P Todd, and J Fry. Okay. Which means these are going to be the accounts that we're going to make against the purchases account. Okay, so let's make these accounts as well. J7, so because J7 is going to be a liability, so we are going to credit it. Okay. J7 is my liability. I'm just going to write liability so that is easier to understand. J7 is a liability. So we debit the purchases and we credit J7, same amount. And against, I'm going to write purchases. Okay. That's the account that we made against it. Okay. Now we have to make the account of P Todd. That was the other account. So we would, because we debit purchases, so we're going to credit P Todd. 390. So 390 debit in purchases, credit in P dot. And here I'm going to write purchases, because that's the account that we're making against it. Okay. Third account that I'm going to make is JFry. JFry is another liability. So write the date first. Write the amount, 810. And here I'm going to write purchases, which is the account I'm making against it. So look at that, debit purchases, credit J7, debit purchases, credit P dot, debit JFry, credit, debit purchases, credit JFry. Okay, so that's how we make the double entry accounts. Okay, now look at the second, which is purchases on credit. So we did some more purchases. More entries in the purchases account, and that are again from P dot 470. And that's happening on which date? That's happening on 3rd. So I'm going to write 3 here. So 470. And that's happening for P dot. So I'm going to write P dot against it. And so debit purchases and credit P dot. Or 79. Second entry is debit purchases 1450, same date. And credit J Mahan, same date 3. Okay. So debit J Mahan and credit debit purchases and credit J Mahan. Debit purchases credit J Mahan. Debit purchases credit J Mahan. J Mahan is a liability. Okay. Against it, I'm going to write purchases because that's the account that I'm making against it. We return goods to J Fry, J Seville. So return outwards or purchase return. Okay. And on which date this entry is happening, let's write down that. So it is happening on 10th. Let's write the date. So 82, his purchase returns are credit. Okay, so 82 would be on credit side. And here I'm going to write JFry. That's the account I'm making against it. So JFry, credit, purchase return, and debit JFry. Why are we debiting JFry? We are debiting JFry because this is the liability decreasing. Okay, we returned some of the goods to JFry. Now we don't need to pay him, so we credit JFry. We debit JFry. Okay. All right. So now look at that. When we purchased from JFry, my liability was increasing, and when I returned goods, my liability decreased. Okay. So purchase return would be the account that we'll be making against it. All right. Then we have purchases on credit from J7. It means we purchase some more products from J7. So we debit purchases and credit J7. What's the amount? 210. Let's credit J7. Date is 15. Okay. But debit purchases, credit J7. Now we paid J Mahan by check. So we paid him. We're gonna make the bank account. Paying by check, so bank account must be credit. It's happening on 28. Bank account is credit with 1450. And we paid it to J7. J Mahan. J Mahan is going to be debited. 1450. The bank account against it. Okay, so debit, credit bank, debit J Mahan because we paid his amount. Okay. We paid J7 by cash, make the cash account, cash credit, 300, and debit J7, 300. We obviously, will put the dates and the opposite account. Okay. Right. And we return goods to P Todd 39. This is purchase returns. Purchase returns would be credit 39. And we're doing it to P Todd. So P Todd must be debit against it because the liability is decreasing. So let's find P Todd account and debit it. P Todd debit with 39. Okay. Now let's close these accounts, balance off these accounts. So we add both sides. So this side is 3579. Obviously, this is the bigger side, okay? Because there is no other side, other side is like 0. So we are going to put it same amount here, okay? And our carried down balance, because carried down balance is the difference. So we have no amount on this side. So the whole account is going to be the difference. Okay. Now look at this account. We are going to add on both sides. Size 121. So that's going to be 121 as well. Carried down is coming on this side. And our carried down is going to be 121. Okay. All right. This account, 1450 on this side, 1450 on this side, and carried down is going to be the same amount, which is 1450. Okay. Same is the case with this account. We only have one side. So carried down is 300. So here, this side is 450. This side was 300 only. So we wrote 450 on both sides, and carried down amount is 450. Here, carried down amount is 869. No, it should not be 869. 869, take away this 39. So P dot balance at the end is 830. Okay. Here, carried down balance is 728. Here, there is no carried down balance because both sides are equal. This is 145, 145. So our account is closed. Okay, all right. So these carried down balances, they actually become the brought down balance for the next year. So brought down balance of purchases is on this side, and that is 3579. For purchase return, our brought down balance is 121. For bank, our brought down balance is 1450. And for cash, our brought down balance is 300. So this is like, the carry down actually goes to the opposite side as brought down balance. Hope you understand it. I'm going to give you a practice question. So yeah. Okay, thank you.